All right, let's talk about a topic that affects pretty much all of us, taxes. More specifically, we're going to dive into some totally legal, totally practical ways for most U.S. taxpayers, those of us earning under $400,000 a year, to save some money. And just to be super clear right from the get-go, there are no secret loopholes or magic tricks here. These are just smart, legitimate strategies that you can actually use.
You know, I love this quote from our source material because it just hits the nail on the head. This isn't about finding one massive tax break. It's about making a bunch of small, smart, and, most importantly, legal moves that really start to add up. So, let's break down exactly how you can do that.
So, we're going to kick things off with the easiest wins, the stuff that's probably already available to you right at your job. Honestly, this is the lowest hanging fruit when it comes to cutting down your taxable income.
First up, let's talk commuter benefits. If your company offers this, you could be putting aside up to $300 a month before taxes to pay for things like the train, a bus pass, ride shares, even parking. That can add up to $3,600 a year that you just don't pay income tax on. It's basically a discount on your commute, and so many people just don't take advantage of it.
Okay, next up is a big one, your retirement plan. Doesn't matter if it's a 401k or a 403b, the principle is the same. Every single dollar you contribute before taxes is a dollar the IRS doesn't get to tax from your paycheck. It's an incredible two-for-one deal. You're building your retirement nest egg, and you're lowering your tax bill right now.
Now, if you have a high-deductible health plan, you have to know about the Health Savings Account, or HSA. This thing is like a superhero of tax savings. Seriously, it's a triple threat. You get a tax deduction for putting money in, that money can grow tax-free, and then you can take it out tax-free for medical expenses. It just doesn't get better than that.
An FSA is kind of like the HSA's cousin. It also lets you use pre-tax money for health stuff, which is great. But, and this is a huge but, there's this one critical difference you absolutely have to understand, the use it or lose it rule.
And here it is, the main event. With an FSA, that money is generally gone if you don't spend it by the end of the year. Poof. An HSA, on the other hand, is your money. It's yours forever. It rolls over year after year, and you can even invest it. Think of it like a 401k, but for your healthcare. It's a massive difference.
And hey, don't sleep on the other kind of FSA, the Dependent Care FSA. If you're paying for daycare, summer camp, an after-school program, or even adult daycare for a parent, this is a game changer. You get to pay for all that expensive care with pre-tax dollars, which can save you a ton.
Okay, so we've covered your paycheck. Now let's shift gears and talk about your investments. Because look, making money on your investments is awesome, but keeping more of it after taxes, that's even better.
Now, this might sound a little strange, but when it comes to taxes, your investment losses can actually be your friend. Why? Because you can use them to cancel out your gains. And our source material specifically calls out crypto here. You're not going to get a nice clean tax form for your crypto trades, so a lot of people just forget to report their losses. Don't do that. You're just leaving money on the table for the IRS.
Okay, get ready for this. What if I told you that the tax rate on some of your investment profits could be 0? Yep, 0%. For folks under certain income levels, if you hold an investment for more than a year, the profit can be completely tax-free on the federal level.
And this is exactly why timing is everything. If you sell an investment in under a year, that profit gets taxed at your normal high income tax rate. But if you just hold on for one single day longer than a year, it becomes a long-term capital gain, and the tax rate gets slashed, often in half, and like we just saw, sometimes all the way down to 0.
All right, here's a pro tip that could save you a serious headache and a lot of money. When you get that tax form from your brokerage, the 1099-B, don't just blindly plug the numbers into your tax software. You need to stop and look for one specific little box.
And that box is for your cost basis. It's just a fancy way of saying what you originally paid for the investment. If that box is empty, the IRS automatically assumes you paid 0 for it, that it was free, which means they'll try to tax you on the entire sale price, not just your profit. This happens way more often than you'd think, so please check for it.
Okay, for our final part, let's look at a few powerful and maybe even surprising deductions that a lot of people completely miss. Now, these are for specific situations, but if one of them applies to you, the savings can be huge.
We're going to hit 3 quick things here. A rule about gambling that can help if you get lucky, a really cool and little-known loophole for renting out your house, and a simple fix to your paycheck that can save you from some annoying penalties.
So, let's say you had a great day at the casino, and you get a W-2G form in the mail for your winnings. Good news. You can actually deduct your gambling losses for the year against that win. If you won $5,000 but can show you lost $4,000, you only owe tax on the $1,000 difference. The key, though, is you have to be able to show it, so keeping records is crucial.
Homeowners, you're going to love this one. It's sometimes called the Augusta rule because of the Masters Golf Tournament. Basically, if you rent out your main home for 14 days or less, total for the entire year, all of that rental income is 100% tax-free. It's an incredible way to make some extra cash if there's a big event in your town.
And finally, let's talk about your paycheck. Do you dread April 15th because you always end up owing the IRS a big check? If so, not only is that stressful, but you're probably getting hit with an underpayment penalty too. The fix is pretty simple. Adjust your W-4 with your employer to have a little more taken out each paycheck. It'll save you the big bill and those sneaky penalties.
Okay, wow, we have covered a lot of ground. So what's the big takeaway here? How do you actually put all of this information into action? Let's tie it all together.
Instead of trying to memorize 14 different rules, just think of it like a 4-point checklist. First, am I getting every possible tax benefit from my job? Second, is my investment strategy smart about taxes? Third, am I missing any of these weird but powerful deductions? And fourth, is my paycheck set up correctly? That's it. That's where all those nickels and dimes are hiding.
So, the whole point of this was to show you that you have a whole toolkit of small, legal, and actionable strategies you can use. There's no single magic answer. So the only real question left is, which one of these small changes are you going to make to keep a little more of your hard-earned money this year?